State lawmakers are debating potential tax cuts, and predictably, those cuts are generating some opposition. In a recent John Locke Foundation research brief, Brian Balfour explained how not to argue against tax cuts. Brian is Senior Vice President of Research at the John Locke Foundation. And Brian, you were looking at an argument against the tax proposals put forward by NC Policy Watch, a left-of-center group. And you basically said they kind of missed the point.
Yeah, they missed a lot of points. Some of the biggest ones that I highlight, I think, right off the bat is their claim that these tax cuts are only going to benefit the rich. And there's so much wrong with that. If for starters, when tax cuts, when the taxes are reduced on the state's economy, that boosts the state's economy. That means more jobs, more opportunities, and that those benefits are going to accrue to those on the margins of employment. Low-income households. These impacts of the tax cuts don't just occur in isolation. There's broader impacts beyond just, say, the person who's writing out the check to the Department of Revenue for the taxes. Those benefits that accrue beyond just those individual people, and there's a lot of others that we can try to get into. There was a lot to choose from in that article. I tried to focus on just a few key points in my article.
I'm going to mention a couple of the ones that you brought up in your article. One of them is that the argument that the elimination of the corporate tax will provide little benefit for the least well-off, with the majority of benefits going straight into the pockets of the wealthy owners and shareholders. You go into detail, but your first word is wrong.
Right, yeah, and that's a common misperception that they try to put out there, opponents of corporate income tax cuts, specifically in this case. And what the research shows, and really just common sense and basic economics would tell you, is that a corporate income tax is really a tax on the workers, right? When you raise the cost of doing business on corporations, they need to cut costs elsewhere. And the biggest expense for most businesses and corporations is payroll, workers. So the research is out there. Common sense tells us that when you tax corporations, you're really taxing workers. You're going to suppress worker wages below what they would be without the tax. So when they try to say a corporate tax only benefits wealthy shareholders and claims such as that's just simply wrong. It's simply untrue. The benefits of a corporate tax would accrue primarily to the workers themselves.
You also focus on the proposal for lowering the personal income tax. Once again, Policy Watch claims this would disproportionately benefit the rich. And you look at this and say, wait a minute, they're missing how this actually works.
Yeah, one thing that was almost humorous in a way is that they were griping that the lowest income households would not receive any benefit from this personal income tax cut. But the fact of the matter is the lowest income households are already not paying any state income tax. So it's kind of redundant to say that those people already not paying any income tax will not get any additional benefit from a state income tax cut. So that's just another example of where they just are really sloppy in their analysis.
And you also point to something that is completely left out of the Policy Watch analysis, and that is changes that would exempt more people from the tax because the standard deduction goes up, and other things that actually benefit those at the lower end of the income scale.
Yeah, right. Part of the tax reform of this proposal is, as you said, increasing the standard deduction. Some of them refer to it as the zero tax bracket. So people at the lower income levels, more of them would be completely exempt from the state income tax, and they completely leave that out of their analysis in this Policy Watch article. When again, they're trying to claim that the benefits are just merely accruing to the wealthy. That's just simply not true.
And you mentioned another piece of this proposal that benefits those at the lower end of the scale, the child tax deduction.
Right, exactly right. Similar to the standard deduction, the child tax credit would be increased, and of course that's going to benefit. And that, I believe, is people at the higher income levels are not even eligible for that. That phases out at the higher, so that's not going to benefit higher income taxpayers at all. So those benefits accrue almost exclusively to middle class and working class and lower income households.
One other item that's important to mention, and that is that you see a misconception that income is the same as wealth, and that by having that misapprehension of the way that works, that also makes this analysis flawed.
Yeah, and that's something they kind of do in this NC Policy Watch article. Is they use those terms interchangeably, but that's not necessarily true. Income is more of a snapshot, your income for that year. Wealth, of course, is your accumulated assets that can be accumulated over a length of time. So, for example, I use in the article, imagine a small business that was shut down for the last year and a half by Cooper's COVID shutdown orders, piling up debt, and barely scraping to survive. And then finally, now that the shutdowns are opening up, maybe this small business has a good year. So on their tax statement, their income looks like they're can afford to pay a high tax bill, but in the reality, they're not wealthy at all. They're strapped with debt and they're struggling to get by. They have one good year to try to start paying down the debt. But according to NC Policy Watch, they should be taxed hard because their income is high, and they conflate that with being wealthy.
One final point I want to get to, and this is near the end of your brief. You say that Policy Watch's analysis is predictable, sloppy, and naive to second-order effects of tax policy, but mostly the contrast is one of perspective. And then you say this is basically comes down to who should make decisions about how to spend the money, the people who earn the money, or government officials and bureaucrats.
Right. Yeah. I mean, really underscoring and underlying these kind of debates is just that philosophical difference. Should the money you earn, how that is spent, should those decisions of how that money that you earn is spent, should that be made with your discussions with your family at the kitchen table, or should it be taxed away from you and the decisions for how your money is spent be made in committee meetings by people who have never met you in committees and back rooms in Raleigh, in the state capitol, by politicians who are self-interested and have their own agendas they're trying to fill. So that's really what I try to underscore when I'm talking about these type of issues. That's really underlying this argument.
If you'd like to learn more, you can log on to the John Locke Foundation's website and look for the research brief with the headline, How Not to Argue Against Tax Cuts. Its author is Brian Balfour, Senior Vice President of Research at the John Locke Foundation. Thanks so much, Brian.
Thank you, Mitch.